Tick tock, tick tock. Do you hear the tax deadline approaching? Here with us today is Nina Olson. She is the National Taxpayer Advocate. She works for you inside the IRS. Is that about accurate?
That's about right, yeah.
So as the National Taxpayer Advocate, we figured we'd ask you a little bit about, we're in the final countdown now of things people can do and will have to do before they file. A lot of people might just say it's not going to happen in the next week or few days. I need an extension.
Right.
Can you go online and just do that electronically?
You can go online. You can go onto any of the free file sites. You can go to the irs.gov. You can file it electronically. You can go online and print out the form and mail it in.
That's Form 4868?
68, that's correct, and it's a 6-month extension. Now, people need to remember that it's an extension to file your income tax return. It's not an extension to pay.
There is an interest rate associated with this. It's not as high as you might have on a credit card, but it does accrue daily, right?
It accrues daily, so you're paying interest on interest every single day. And not only that, but if you don't pay timely, there's a 0.5% a month for penalty for late payment. And then there's interest on that penalty that accrues daily. So you've got the penalty, and then you've got the interest on that penalty, and then you've got the interest on that penalty.
So if you can pay it, but it's a nice safety valve. They will give you the credit. No credit checks and you're good to go.
That's right, and yeah, it is that. Now, we always say that the IRS is the worst person to borrow money from because there are consequences with that. If you can't pay timely, and even you may enter into an installment agreement, they may file a lien against you, which can really damage your credit.
Okay.
But you know, if you really can't pay, and you can call the IRS, you can try to get an installment agreement. You can get it. They'll generally do it if you can pay in 5 years. But again, you're going to be paying more to the IRS than you would normally pay to someone else because of that interest factor.
A lot of homeowners or former homeowners have a big liability right now because they got what looks like a big windfall, but it's not really the windfall you want to get. They did a short sale. The bank
repossessed,
repossessed, or they have a credit now on the amount of debt that was forgiven. Not a credit, I'm sorry.
A forgiveness.
A forgiveness of debt.
And they owe tax on that forgiveness. And that's sort of counterintuitive. People think, well, you know, I didn't get anything for that. Well, you got the ability to purchase that home and you've given up the obligation to repay.
Now that is
and that's a benefit to you.
Is that taxable income in this year? In the year
it's in the year that the forgiveness occurs, and you will get from the bank a statement from the lender that says this is how much of debt was forgiven to you.
If you already lost your home, you're probably not flush with cash. So
right.
You probably can't discharge this right away. What are your options?
Right. Well, Congress passed a law for principal home mortgage indebtedness, qualified principal residence indebtedness, and that is debt that was used to buy or improve a home. That you will be able to exclude it from taxable income, you know, not use it as taxable income. You have to tell the IRS.
This is money you borrowed,
and you don't have to
repay.
Home. That's right. You borrowed it to put into your home, and now it's been forgiven you because your home's underwater, you know, and then what you do is you tell the IRS that this portion of the debt was used to buy my home and improve my home, and so it's excluded from income. Now, if you refinanced your home or you had a second mortgage on it, you know, an equity line or something like that, and you used it to pay for school, for your kids' college education or medical expenses,
new tires,
or
trip
a
to Bermuda.
nice trip to Bermuda or whatever, that is not going to be excluded under this provision. Now, you still may not have to pay taxes on that. You would have to show the IRS that you are insolvent.
Insolvent meaning you don't have the assets that equal the liabilities?
Right. It does. Whatever if your liabilities, your debts, are greater than your assets at the time that the debt was forgiven, then you can exclude the other kinds of debt up to that negative number.
Very important here, though, is that your retirement assets are included as assets. In this calculation.
Right. A lot of people think, well, regular creditors can't get my retirement assets. They're protected.
Uncle Sam can.
Uncle Sam can, and also it's counted as part of your assets in this equation.
Okay, a few good things that have happened this year. An adoption credit, very generous.
The adoption credit was increased by the Affordable Care Act, that you can now have a tax credit, which is refundable.
Money
and I'll explain that. Money coming to you, up to $13,170 for attorney fees, for travel if you're going somewhere to get the child or visit the child, any adoption expenses, a whole bunch of adoption expenses. And if you don't have a big tax liability up to $13,000, you would get the difference back, credited to you. So that's a big thing.
As with last year, and you need to get receipts for donations of property.
Yep.
Getting close to, let's say, the Salvation Army, less than $250 what do you need?
You just need a receipt. Unless you've dropped it off by the wayside, by a bin, then that's impractical. So you should just keep a record that this is what you dropped off.
Can you give an old junker and say it was worth $10,000?
Well, you have to do fair market value, and if the charity sells the car, then it's whatever they sold it for. And they're supposed to send you a form that tells you what they sold it for within 30 days of them selling it. So.
Okay. You've got a lot of other great advice on the website there. That's taxpayeradvocate.irs.gov. She's Nina Olson. She's National Taxpayer Advocate.